Now let us look at some of the principles regarding the revenue recognition, when it should be realized, when it should not be realized, and what are the implications or what are the suggestions provided by the FASB. Under the accrual system, as we have discussed earlier as well, that revenue is recognized when it is earned. So it must be recognized only when it is earned, and it should not be recognized when it is not earned or still it is due. And we have also learned that while we were talking about revenues and its recognition when it is earned, then we also need to look at that expenses should be recognized when they are incurred. So when expenses are incurred, they needs to be recognized. So we have learned this in the accrual principle of accounting. However, the FASB has provided a lot of guidelines on how and when it can be realized. They've given two conditions. One, that the revenue must be realized or realizable, and number two, that it should be earned. So if both these conditions actually meet, you can actually go about recognizing revenue in your balance sheet. In addition, then there are some certain guidelines which are provided by SEC, and there are four guidelines. One, that there should be an arrangement between buyer and seller. This is guideline number one. Number two is that the product has been delivered or services has been rendered. So if product or services has been delivered or rendered, then you can actually take this as the revenue on your income statement. The price must be determinable. So probably this is also one of the conditions to look at. And number four is that you must be sure of, or probably I must say that you must be reasonably sure of collecting money. So if these are the four conditions that are met in addition to these two, then you can kind of go about recognizing revenue in the income statement. And obviously, these are very important because if you look at two conditions, revenues can be recognized a bit earlier or later, depending on how is your revenue recognition policy as a company. So management has a lot of incentives to kind of manipulate their revenues, because it will have an impact on the net income, which is ultimately tracked by the shareholders. So kind of a very tricky issue. You need to be sure about when the company must recognize its revenue. So, and revenue recognition policies are of different kinds. So we'll now look at how a long-term contract can actually classify its revenue by using various methodologies provided by the FASB. So let's talk about the long-term contracts and how they are kind of recognized. When we talk about the long-term contracts, one assumption that we are making here is that period that we are talking about is more than one accounting period. So it's more than 1 year for sure. Okay, and long-term contracts can be recognized using two set of methodologies. One is the percentage completion method, and the second one is basically the completion contract method. So completed contract method would be the second one. So what are the difference between the two? Percentage method essentially means that if the revenue can be reasonably estimated and the project cost can be reasonably estimated, then you can kind of go about using the percentage completion method. So revenue and cost both must be reasonably estimated, so you have a fair idea of what is going on. But when we talk about the completed contract method, we probably are unsure of the outcome of the project. You're kind of unsure here. So when you are kind of unsure, then you need to use the completed contract method. Now coming to the working mechanics behind the two, percentage completion essentially means a simple thing. If the project is 25% complete, then recognize 25% of the revenues. And when it is 50% complete, recognize 50% of the revenue. So percentage completion method. Completed contract method essentially says that revenue and expenses can only be recognized when the contract is complete. So recognize all revenues and expenses when contract is complete. So only on completion of the contract you will recognize all revenues and expenses at once. Before that you will not do anything. So let's take an example and see how it actually works. So let us now take this example on percentage completion and completed contract. Now here we have been provided that the contract price is $1 million and the estimated cost is around $800,000 and the start date is 1st January and the finish date is basically 31st of December 2009. So this is basically a 2-year kind of contract, and since this accounts for more than one accounting period, we'll be taking this as a long-term contract, and hence either ways we may have to take it like a percentage completion or a completed contract method. Also provided in terms of information is that cost to date is in 2007 it was 200,000, in 2008 the cumulative costs is 600,000, and 2009 when the full cost needs to be disbursed, this is 800,000. Likewise, cash collected during the year is also provided to us. Now the objective of this whole question is that we need to calculate the revenues and the gross profit figures in each of the years. So let's start with the percentage completion contract first and see how it goes. For the percentage completion for each year, we must find how much amount was completed in each year. So let's take this 2007. The total cost that was incurred was 200,000 and the total cost that is committed is 800,000. So this is 25% was actually completed in 2007. What about 2008? In 2008, we saw that the total cost that was completed was 600,000. So basically we'll try to calculate the fraction. So here it is 75%. And for 2009, the whole cost is being allocated. So 800,000 divided by 800,000. So this is 100%. So as we see here, 2007, 25% of the total amount of work was complete. In 2008, another 50% was complete, so that the cumulative number is 75%. And in 2009, another 25% was complete. So revenue must be recognized in the proportion of work that was completed in that year. That is 25% in 2007, 50% in 2008, and 25% in 2009. So let's do that and see how much is the revenue that gets recognized here. So this will be 25% multiplied by the total revenue that is committed is $1 million. So this is 100,000. So this comes out to be $250,000 as the revenue that is recognized in the year of 2007. What about the gross profit? The gross profit would be the difference between the revenue that is recognized and the associated costs. The cost is basically 200,000. So we subtract 200,000 from the revenue that gets recognized. So this comes out to be 50,000 here. Okay, so this is basically for 2007. So let's look at how this number pans out for 2008. For 2008, the amount of work that was completed was 50%. So it is 50% multiplied by $1 million. So again, this comes out to be 500,000. And the associated cost is basically the difference between the two, 200 and 600. So the associated cost is basically 400,000. So the overall gross profit comes out to be 100,000 here. So let us complete for 2009 real quick. Here we noted that 25% of the work was complete in 2009. So we will recognize 25% of the revenue. So this comes out to be $250,000, and the associated cost is basically 800 minus the 600, which is the total cost. So this comes out to be 200,000. So what we note is that the gross profit is $50,000. So this is the gross profit. Revenue recognized was 250 million, 500 million, and 250 million. And percentage complete to date was 25%, 75%, and 100% respectively. So now let's look at how the profile of revenue gross profit would actually come out when we look at the completion contract method. Now while we look at the completed contract method, the first column to actually fill this is percentage complete to date. So here we had earlier found that this was 25%. In 2008, the overall completion was 75%, and In 2009, the overall 100% was completed. So what we note as a characteristic for completed contract is that the reasonable estimate is literally impossible to make with respect to costs and the revenues, and hence we recognize revenue only when all expenses are met. So 100% of the expenses are done. In that year only we recognize the revenues and the associated costs and report the profits. So here when we talk about years of 2007, we have noted that this is only 25% complete. So revenue recognized will be zero, and cost will be again recognized will be zero. So gross profit will be zero here. For 2008, again the same thing will happen. Here it will be zero, cost will be zero, and gross profit will be zero. Now coming to our 2009, what we notice that the revenue recognized will be full 100% of the revenue. This is 1 million, and the cost is basically $800,000. So what we note here is that the gross profit in year 3 or 2009 is reported as $200,000. So this is how the key difference between completed contract and percentage completion actually pans out.